Hi, everyone. Welcome to YX Insights. Today is the final market update before the new year. And a lot have happened since last week. We had the FOMC meeting, which drove a big market sell-off. And today is options expiry date. And the market seems to be in extremely fearful mode. So let's just have a quick look about what happened in the FOMC, and as well as today's PCE, if that changes anything, and a live market analysis of the major tickers in SPY, QQQ, RWM, gold, silver, as well as the major crypto pairs. The headline PCE came in at 2.4% year on year, which is actually better than the estimate. And it's ticked up a little bit again from October. So we bottomed in December at 2.1, and now it's moving away from the Fed's target. The core PCE came in at 2.8%. So that's the second 2.8% in a row, but still slightly better than where the market had forecasted. Yields moved a lot today. Just before the release, maybe the data was leaked, but also after the data got released. Compared to what we had from Wednesday's FOMC release, we're actually pretty much where the Fed had projected for the year end. So 4.2 for the headline and 2.8 for core PCE. So the key question, and that's what's driving the market crazy at the moment, is this 2.5% for both PC headline and core PCE inflation. The Fed actually think the headline inflation will get worse next year, and core PCE will come down from 2.8% today to 2.5% by December next year. But again, that's quite a big jump from where they previously projected at 2.2, and that was before the November US election. So Powell had admitted that some of the members have already incorporated their personal views about the incoming policies around tariffs and that impact on inflation, which has driven this big jump. But the truth is, we're way too early to tell exactly the timing of those policies as well as the extent. The Fed has done some modeling around different potentials, and they're using the 2018 playbook, but this time is not going to be exactly the same as the last time. Now we're in a rate cut cycle versus a rate hiking cycle in 2016, 2019. Also, where the trade deficit between US and China has shrunk significantly since the trade war in 2018. So the backdrop is actually quite different. And Trump is actually pretty aware of the fact that Biden administration essentially lost the election because people were angry at high inflation and high price levels after COVID. So Trump is not going to repeat that mistake. If he wants to, Vance probably wouldn't. If Vance wants to, Scott Bessent probably wouldn't, the incoming treasury. And Bessent is an excellent macroeconomist, a hedge fund manager. He understands the impact, the intricate impact of those various policies on PCE, on the bond yields. And his number one job is make sure that the loan and the bond yield doesn't slip further higher, and the budget deficit is getting managed, not to spook the investors. If we have much higher inflation, we get higher yields, and we have to essentially, the Treasury has to borrow at a higher rate. The US is already paying something like $1 trillion a year just on interest alone, which is really bizarre. So they are really having to do a lot of massaging around the bond issuances and the policy offsets to make sure inflation doesn't move higher. The December dot plot shows there are only 2 cuts for next year, which is actually where the market had it before the meeting, and another 2 cuts in 2026, but the market doesn't think there will be. In fact, currently the market only suggests we get to 2 cuts next year, and then that's it. forever, which I do think is getting quite tight. We can get pushed to the extreme case where the market will expect one cut at the beginning of next year or in the summer of next year. But I think that is the pendulum is swung too much. Powell still does think that while we're closer to the neutral rate, the financial conditions are still quite restrictive. So the policy should still be moving towards lower rates from here. It's just the extent and timing that are in question. And finally, just looking at the bond yields, the bond curve is pretty normal now, which means the longer end are substantially higher than the front end. The 30-year is at 4.8%. I think it topped out at 5.2%. I think I personally do think that to get this yield curve moving higher, we'll have to first regress another cut and potentially even move into the hiking territory, which I do not foresee. The difficulty is in the timing, because the beginning of the year for 2025, we see a lot of price jumps from businesses and services raising their price in big chunks at the beginning of the year, which is what happened in 2024. So that will throw in a little bit of uncertainty about the bond pricing and inflation data. But I think post Q1 next year, we should see a reversal in yields and potentially also lower inflation than what the market expects as well. And just the point about tariffs, if Trump does go with the tariffs, I think first he's trying to offset some of the impact through lower energy, so greater energy supply domestically, increasing the inventory and lowering the energy prices, which is not what the Middle East and OPEC Plus wants to see. But that could offset some of the year one impact of the tariffs. But tariffs are one-off effects, right? So it's like a tax on the imported goods. You tax it once, prices go up in year one. Year two, it doesn't go up anymore because it's not a incremental tax annually. And if actually the trade negotiations proceed quite well in year 2 and 3, and tariffs get unwound from there, we could actually even see lower inflation from there. So there's a lot of uncertainty. I think the market is pushing ahead too far at the moment. We're pricing really tight monetary policy on the back of it. So I think give another quarter of uncertainty, and we can see reversal once the administration sets out policies. SPY, I am still not really convinced this is a wave 3 down, but it could be. Essentially, we're at this support level now, where from September, and I think the reason I feel like we haven't really completed wave 3 because this wave here is only a 1.236% extension of wave 1, and it's on the smaller side. However, it's not really a steady and fast rule. It has to be higher than this. As long as wave 4 is above the wave 1 in this scenario, we could potentially consider this as wave 3 done, which means we have to move the wave 5 lower to somewhere towards here to 630 region. And typically, if we did top out wave 3 over here at 1.236 region, we could retrace potentially to 575 for further, but we're now into the support region here, essentially. And so the balance is that we should get bounce back from next week. QQQ, I do think we did top wave 3 here at 1.382 extension, which I just mentioned, that SPY didn't reach. So we topped at 539, which is good enough. And typically we can see a retrace between 500 and 513 over here. So we're entering this supportive zone here. I'm not saying the market will go straight up from here, but here we're getting into a oversold or get into a territory where the correction is coming to completion. IWM should have definitely completed now the wave 4, coming from a really high zone of 1.764 extension of wave one. And I do think in the next 2 weeks, we should be trying to move towards this wave five territory in the 270. It doesn't feel like that now because everyone's fearful and this dropped really fast. But in terms of levels, we have fallen enough to now start thinking about an immediate bounce. TLT, the PCE data today were better than expected, in line with the Fed's projection, which is good. So I think originally I did have this coming down. It could be coming down as far as 86 to 87. We did reach the 87 level yesterday. We could be, I think here we're looking at reversal. I don't think we're going to go straight up, but I think we could be consolidating here, trying to form a bottom into January, March, and then steadily climb higher in Q2 next year. So I think we need to be a little bit patient with TLT because a lot of the macro picture is quite unclear. But I think most of the move down is now behind us. Gold, my read is that gold hasn't quite finished this wave C yet. And I can see it coming down to 230, 225 level. So that would be putting wave C equivalent to wave A. However, if it is a really shallow ABC and we're looking up, there is a possibility, bullish possibility for this 1-2 to be forming. I don't think that is the case, but I'm just I'm not oblivious to the chance of that happening. So I think China has started buying, and I think a lot of BRICS countries are looking to de-dollarize and buy more gold. But we need ETFs and retail support from US and Europe, essentially for the final leg of the blow-off top. Silver dropped quite quickly in the past 2 weeks. I think we could see a bounce here. I feel like the end of wave 4 is probably near. And so the next leg up could be more constructive. Slightly running ahead of gold, but typically they're quite correlated. So this wave C could extend a bit further. So I'm a little bit cautious as well. Silver hasn't held as well as gold in the past week. Bitcoin, it didn't quite reach my wave 3 target of 112. I did feel that if we definitively get above 110K level, that would be quite a good place to start a correction here, and then finishing wave 4 and then wave 5. Currently, we haven't really breached this wave 2 low, so we're still in play for this entire 5 waves up. All of this was leveraged longs getting liquidated in the past 3 days, something like 2 or 3 billion since Wednesday. I still think we can get a Christmas rally from here, although 120 may be looking less likely now given the extent of this fall. But I'm constructive going into year end. January is when I start to get really cautious about crypto generally. Ethereum, we already did think that the 4,000 was a top. We were expecting wave 4 correction, then wave 5 up. It seems that the past 3-4 days, the job has satisfied this wave 4, and I think we can be looking for wave 5 up. And I'm just going to show you the levels I'm looking at. So we reached the 2 extension for wave 3, now retracing to 1.236, and I think we can get to at least 4,500 to 5,000 in the final leg up. Solana, similarly, I drew this box before the wave 5 happened, but that was the area of resistance. And now I think we've completed ABC, and we're probably building a wave 2 low from here. XRP, we haven't really breached this bottom from here. I do feel there's one more leg down to finish this wave 4 before we head higher. I think the final leg can be higher, just with this. I think this wave retreat here will draw people to buy the dip, and then aim for the wave 4, aim for the wave 5 high of $4 plus. So that's it today. It's a short session. I wish everyone a Merry Christmas and a Happy New Year. Over the next 10 days, I'm thinking about building a dashboard on my website, so there will be fewer single names stocks, but I'll be always sharing charts on Slack upon request. So have a good weekend.